Yeah. Hi, dear. I don't even know what this.
One. Good evening, Oluwabumi. Good evening, Favor, Maureen, Veronica. How we doing today?
Good evening, Ma. We are doing very well.
Evening. Awesome. Thank God for today. I hope you had a good time today. I hope it wasn't a stressful day.
That's
Good
cool.
evening, Ma.
Good evening. Today is Friday. I hope wasn't stressful.
It is stressful.
I
We
can
are,
I
we are
can
getting this
imagine.
Friday anyway.
Very
Yeah.
stressful.
You're getting what?
We are grateful it's Friday.
Yes, yes, very grateful. Very grateful it's Friday. Yes. At least you can catch some breath and still be able to achieve your goals over the weekend. That's the beautiful thing. All right. Okay, so today we'll just write in and I believe you can see my screen. Can you? Can you see my screen? Don't go quiet on me today. Can you see my screen?
No, Ma.
No,
You
Ma.
cannot? No.
No,
Wow.
Ma.
Okay, okay, all right. Let me fix that. Let me fix that. Okay. Yeah, what about now? What
Yes,
about
Ma.
now? Oh, beautiful.
Yeah,
All right.
no, we can.
All right. Thank you very much. So we're going in again with another topic. Before we begin, I want us to pray. Just commit the entire class into God's hands, asking God for his help, asking God for direction. So let's just pray on our own. God, give me direction, show me, help me know where to put my effort, where to concentrate, what not to overlook, what something that shouldn't just pass by. Help me, Lord Jesus, to see what I need, to excel in this examination. Supply me, Lord, with strength to be able to carry on, not to be tired, not to be weak, but to keep going. Help me, Lord Jesus, remove any barrier my way that wants to hinder me from attaining success in my ICAN examinations. Father, help me provide all that I require, all of the resources that I require, for me to excel in the examination. Thank you, Jesus, because we believe and we know you've heard our prayers, you've answered our prayers. We give you all the glory. In Jesus' mighty name we pray. Amen. All right.
Amen.
Yeah. So we'll be going in on IFRS 15 today, which is revenue from contracts with customer. All right. So we're going in with that today. So what exactly is this standard about? Now, the standard basically wants us to be able to understand when to record or when to recognize revenue and how to recognize the revenue or how much to recognize as revenue. Now, this standard seeks to help us to know what to consider before revenue can be recognized. And if you understand the impact of revenue, I like to say there are like five major items, in accounting or in financial statements that should not be treated with levity, you know, and revenue is one of such. And it's such that revenue stand on its own, It's not like your typical assets. Assets comprises of other things. You have non-current assets, you have current assets, and you have different classifications under your assets. Same with liability, same with equity. But when it comes to revenue, it's like just on its own, right? But that on its own, there has to be like a proper guideline on how to recognize, revenue. And that's what the standard says to do. So it helps us to understand how to recognize revenue from contracts with customer. Now, that word contract is also very, very strategic. There's a reason why it is called a contract. And from our understanding of law, we understand that when it comes to contract, there are parties involved and there are obligations to be fulfilled. So if those obligations are not fulfilled, then the contract might not be binding. All right, so we understand that. So IFRS, of course, is also riding on that terminology. So according to IFRS 15, revenue is income that arises in the course of an entity's ordinary activities. Remember that when we were treating IS and the conceptual framework, yes, and we're defining the different elements or the different items in the financial statement, we were clear to understand what revenues are, and we're also clear to recognize what gains are. All right. So we'd say revenue is in the ordinary course of business, gains are not in your ordinary course of business. All right. So revenue are income that arises in the course of an entity's ordinary course of activity. So what it means is that a customer, for instance, the party that has contracted, because if income will be arising, or income will be coming up into the organization as a result of an entity's business or activity, it then means that the entity would have probably contracted with another another entity or another individual. So that person, for instance, will be a customer. All right. That customer also applies to clients and any other terminology. So a customer is a party that has contracted with an entity. That means there's something binding. There's something binding. They both come to an agreement to something. All right. So you provide me this service, and I will pay you for this service to obtain goods and services that are, of course, an output of the entity's ordinary activities. So we're saying that that contract is gotten into in order for the customer to obtain, some certain form of goods or services from the entity that is within the entity's ordinary course of business. Very striking and very important. These things are not to be, you have to learn it. The 5-step model for recognizing revenue. There is a 5-step model. I would tell you for sure, ICAN has, I want to say, overflocked this question, both at the FR, both at the former CR. ICAN has asked a lot of questions on this, the 5-step model, the 5-step model. All right. So don't still overlook it. Don't say because a lot of questions have come up in the past, they might not be tested. That might not be 100% true. So it's important we understand. And apart from just knowing the steps, we also need the steps. We also need to know the steps in order for us to screen, transactions or events. Now, the question might probably come, and then you have to screen through. Thus, this event, does it fulfill the condition? Should revenue be recognized? So what are the things to look out for to know whether revenue should be recognized? If you look at the last step here says recognize revenue. All right. So before we get to the last step, what should have happened? Number one, there has to be an identification of a contract with a customer. There must be. And that contract might be written, might not be written, but there must be a contract with a customer. There must be some form of identification of, oh, I'm going to be supplying you a certain set of service. You're going to be paying me for that service. So identification of a contract. It could be implied. All right. So the next step is identify that there is a separate performance obligations. Separate performance obligation. So the customer has a performance obligation. The entity also have a performance, obligation. All right. And then after that, the next thing is to determine the transaction price. Now, the transaction price talks about what will be paid for the service that has been offered. And the next one is to allocate the transaction price. So you wonder why are we allocating the transaction price to the performance obligation? Now there's a reason why we need to do that. Sometimes some obligations are going to be performed over a period of time. And now if something is going to be performed over a period of time, then we understand that revenue is supposed to be recognized in the period in which it occurs, whether it is earned or paid, whether or not. So if it's going to be if a transaction is going to be performed over a period of time, sometimes it could be over a period of 5 years, over a period of 4 years. So in as much as you've gotten into a contract in 2025 for a 5-year, contract for you to deliver services to another entity for 5 years, there is a possibility, because we've always thought as accountants, or we've always said as an accountant, that we recognize revenue whether the service, or whether money has been paid or not, whether it has been earned or not. And so there is always that misconception that if I'm entering into a 5-year contract, for instance, and the contract says I'm going to be paying, or somebody's going to be paying me, let's assume 5 million naira for a job, that will be done. Okay, so I'm going to be receiving 5 million naira over for a contract or an obligation that will be performed over a 5-year period. And so there's always that misconception that even though the entire 5 million might not have been paid in the beginning. Sometimes the organization, maybe they want to pay 1 million every year, right? So they've paid 1 million, but we know we don't really recognize revenue based on whether cash has been received or not. So we would then say, oh, that means the entire 5 million should be recognized, because the contract was signed in 2025, and the entire 5 million should be recognized. Now the problem with doing that is you won't then be able to match the revenue with the associated cost. Remember that the performance will be performed over a period of time. So there is no way you perform everything in 2025. You'll be performing some in 2025, some the customer is you'll be performing some to the customer in 2025, some in 2026, 2027, 28, like that, and 29. So you're going to perform it over 5 years. So recognizing revenue in year one, you are not recognizing the entirety of 5 million in year one. And the associated cost to that 5 million naira in year one cannot be equivalent, because that cost will only be recognized. You only recognize cost for the beginning, which is year one. You won't even know what cost you might need to recognize year two. So it's like you have overestimated your revenue and underestimated your cost. So your cost is not matching. So that matching concept has not been obeyed. All right. Your cost is not matching your revenue. All right. So that's why this standard is very clear on when revenue should be recognized. So are we going to be recognizing it over a period of time? Are we going to be recognizing it at the beginning of the contract? So that's what this standard is trying to tell us, that if you're going to be recognizing or going to be performing an obligation over a period of time, then it makes sense to recognize revenue over the period in which the obligation will be performed. All right, so we'll be looking at how all of this work out. Then the last part is for us to recognize revenue when when or as an entity satisfies. So that means when or as they are satisfying it as a 2025, whatever it is, are satisfied, I should recognize revenue associated to that. 2026 associated to 2026. So as an entity satisfies the performance obligation, that is when revenue should be recognized. And so we have the COPA as like an abbreviation for the file, because I don't want you guys to forget this. This is very important. So COPA means customer. So that way, or you can also look at it. I think I would stick to you looking at it from contract point of view, even rather than customer. All right. So contracts, then the performance obligations, the price, transaction price, allocation of the transaction price, and of course, recognize revenue. You don't have to use COPA. You can use anything as long as you can remember this is a step. So one must precede two must precede three. It has to follow this particular order. All right, so let's begin to explore each of these 5-step model and see how it works. So the first one is to identify that there's a contract. All right, so what does that mean? It might be written, it might be oral, it might be implied. All right, so it doesn't have to be that, oh, there's a receipt given. No, it can be anything: written, oral, implied by an entity's customer business practice. So another question is, how has the entity been transacting business with its customer? So however the entity has been transacting business with its customer, then if there is a contract that comes in, or there's an activity that the obligation the entity has to perform, and that is in line with how it has always been doing, then it's expected that a contract is therefore has been created. All right. So a contract is an agreement between two or more parties that creates enforceable rights and obligations. So a contract happens at that point in time. So the next thing is, how do we, identify that this is a contract? What are the application, criteria? What are we looking out for? Number one is the parties have approved the contract and are committed to perform their respective obligations. Both the customer and the entity have both approved the contract. And not just that, they're also committed to perform their respective, obligation. The other one, or the next, is that the entity can actually identify each party's rights. So I have a right. Let's even look at what's going on with us right here now, right? So you have a right to get lecture for what you've paid. Or I have a right to probably to be paid for the service I'm offering. You have a right to also to get service for the money you've paid. So the entity can identify each party's right. The entity can identify the payment terms for the goods and service to be transferred. So what are the payment terms? Am I paying 100% at the beginning? Am I paying over a period of time? Am I paying after this? There has to be like a payment terms. And the next one is the contract has what a commercial substance. That is, it is expected to change the risk, timing, or amount of an entity's future cash flow. Commercial substance means it could come in as cash inflows. It could come in as reduction of cost. It can come in as, but we can actually examine it and say, oh, there's a commercial substance that, for instance, it could be that it change the risk of the entity, the timing or amount of an entity's future, cash flow. And the last is that it is probable that the entity will collect the consideration. It is probable that the entity will collect the consideration. When all of these things happen, then we can say we have identified that there's a contract with a customer. So there's an acronym here, but you don't have to use my acronym, which acronym. I use APPCC, so which is approve parties, rights, payment terms, commercial substance, and consideration. So you can determine if that's what you want to do, but just ensure you know this one. So very important. This has not really been tested. So just take a note of that. Now we're going to move to the next part, which is to talk about the fact that we can identify that there is a separate performance obligation in a contract. So the first step says we identify that there's a contract with the customer. The second step is saying, can we identify that there's a separate performance obligation in the contract? All right. So a performance obligation is a promise in a contract with the customer to transfer the customer's either a good or service or a bundle of goods or service that is distinct, or a series of distinct goods or service that are substantially the same and have the same pattern of transfer to the customer. So can we identify that as a performance, obligation? We'll be looking at what we mean by bundle, how when goods are bundled. So how do we relate with that? We're going to be looking at that in a bit. The next one is to determine the transaction price. The transaction price, of course, is the amount of consideration that the entity expects to be entitled to, in exchange for the goods or service that will be given up for the customer under a contract, excluding any amounts collected on behalf of other third parties, for example, sales tax. So we're saying the transaction price is regardless of any other external payments. So how much is the transaction price in this, in this contract? All right. So for instance, I would like to use a real estate business, for example. So in real estate, so there are people they call agents, right, that help to sell buildings and help to sell properties, for real estate companies. And most times when they sell, they would be paid for their service. So sometimes they pay them maybe a rate, maybe 10%, whatever it is, the amount of the property they sell. So there's an amount they pay them. Now, if someone that is an agent, has a company, that what he does is to just be an agent to help real estate businesses to sell off their property. And then it's kind of probably have an account where it wants to recognize revenue. Now, there's a possibility that when they sell properties, they're going to be billing the property in the amount in which the property is worth. So if there's a property worth 10 million naira, so it's going to be billed at 10 million naira. But really, the real amount coming to the agent is not 10 million naira. It's just 10% of 10 million, which is 1 million naira. Now, if the agent is going to be recording or determining its transaction price. Its transaction price obviously is not going to be 10 million naira because 10 million naira is not his own revenue. 10 million naira is the revenue for the real estate in the company. So the agent's revenue is just his 1%, 10% of 10 million naira, which is just 1 million naira. So it's important to determine what the transaction price is. So the agent should, on no condition, then record the entire 10 million naira as his own, revenue. No, it shouldn't be. The price is actually, 10% of that, not the entirety of that. So that's why it's important to determine the transaction price. Now, the next thing is to allocate the transaction price. Now, how do you allocate the transaction price? You allocate, for instance, the transaction price to the performance obligation in proportion to those standalone selling price determined at the inception of the contract. Now, what does allocation mean? For instance, there are some products we would buy and they'll tell us, oh, if you're going to be buying okay, let's take an example. You're buying a laptop, right? If you're going to be buying a laptop from Apple, the truth is you're buying both the hardware and the OS. All right. So, but some people might say, oh, I don't want Apple's OS, though I want Apple's hardware, but I don't want the OS. I want to install Android on my own. All right. So there's a possibility that Apple can actually sell the laptop without the OS. So that's just selling hardware. And there's also a possibility they have to sell the product with the OS. So they may have those two options. And then the customer says, oh, the one I want is the one without the OS, not necessarily the one with the OS. And those that will probably buy the one with the OS operating system might actually have to pay, a considerably lower amount, right? Because they are buying something like a bundled good. They're buying in addition to other things. So there's a way the company might factor it and then give them as a lower price. If they were going to buy them separately, they will have to probably pay more. But because they're not buying them as a whole, they will have to pay less. Now the question is, if we're going to be allocating, the price for OS, price for hardware, how do we allocate? Because the price for both of them has been put together, right? So they didn't sell to us hardware OS. They sold a full laptop to us, but we know that the organization itself have the price in which they sell, OS. They also have the price in which they sell hardware. So how should they now recognize that kind of revenue? So that's what we'll be looking at under how to allocate the transaction price to the performance obligation. All right. So there's an example here. So it's one of the past questions. So very interesting one. It says that okay, maybe somebody should read. Let me hear someone's voice. Who's ready to read? Who is ready to read? Okay, Sekinat. So let me start with Sekinat. Yes. So Sekinat, can you please read?
Good evening, ma.
Good evening. How are you?
Fine, ma.
Okay.
Okay, the question says Funetel Nigeria Limited is a network service provider registered with the Nigerian Stock Exchange. The company has been operating in the country for the past 10 years. On September 1st, 2019, the company entered into a service contract with its customer to provide a special model handset and 1-year service at a price of 250,000 naira. If the customers acquire the handset only, it will be sold at a price of 75,000 naira, and if the network service is separately provided for 1-year duration, the company will be made to pay the sum of 200,000 naira for the 1-year duration. The financial year end of Funetel Nigeria Limited is September 30th. Calculate the revenue from this contract for the accounting year ended 2019 and 2020 in accordance with the provision of IFRS 15.
Thank you. Thank you very much, Sekinat.
You're
All right.
welcome.
You're welcome. All right. So I believe the question, I'll be going through my note now to write. I believe the question is clear. Can I get responses? Do you understand the question? Before we even start solving it, do you understand what the question is about? Anyone? 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 I'm waiting.
think the question has a contract about the contract with two performance obligation. Yes.
Okay.
And then we're giving the, we said that we're giving the standalone prices for each of the performance obligation. Is that what? Sorry, is that what you're expecting?
Mm-hmm. So we
So because
have
I've taken
the.
the question now, so I don't.
I didn't get
think I
you.
want to
Go.
see the question. Please, could you flash the question again, ma?
Oh. Oh. Okay. Because I want to solve. Okay. Can we take screenshots?
Yeah.
I think that might be better. Okay, so let's take the screenshots of the question before I leave. Taking it.
Yes, ma'am.
All right, thank you very much. All right, so I'll be going out of this. Okay, okay, yeah. I'll be going out of this so that. All right, so we have Phone Tech, okay, Phontel Nigeria Limited. All right, so now what are you looking out for in this question? You're looking out for the fact that the organization, right, do they perform the obligation as a bundled product or as a standalone product? Or do they perform it as a standalone contract or as a combined, contract? Now, that's what you're looking at for. Is it standalone? Is it combined? Do they have the culture, the customary, that's what I say, according to the business customary practice, do they have the culture to sell phones and then handsets, in this case, do they also have the culture to sell network service independently? So if they do, that makes it, more interesting. Okay, so that means ordinarily the company can actually sell handsets separately and also sell network service. So those two products are not bundled like that. What I mean is they are kind of distinct products that can be bought on their own. But however, because a customer has come and then they want to make it, they want to give the customer some sort of compensation. So they say, oh, you want to buy both handsets and the network service. What we'll do for you is we'll give you together. Of course, if you're going to buy them independently, you have to pay 275, naira. Because you're buying them both, just going to collect just 250,000 naira from you. So you can see that the price is not matching, right? So if I'm going to buy as a bundled product, a minute, sorry, trying to get my pen. If I'm going to buy it as a bundled product, right? I will have to pay, they're giving me, okay, sorry. Or let me use IFRS word. Let me use IFRS word. Combine products. I'm going to be buying it for 250. But if I'm going to buy it as a stand-alone, I'm going to be paying, I'm going to pay 75,000 and another 200,000. Now, if you look at both of them, this will cost me 275,000. This will cost me 250,000, isn't it? And the product we're talking about is handsets. So this is handset plus network together. This is just handsets. And this is network. All right. But in the books of the account of the business, remember that there are different inventory, right? We did inventory yesterday. There are different inventory. So the organization would have to find a way to record that, oh, an handset has been. Organization will have to recognize that there is an handset revenue from handset that will have to be gotten, and revenue from the network that will have to be gotten. But now they've sold it as a combined product. So the question is, how will they allocate revenue? Because you need to match revenue with cost. All right. So how will they match the cost and the selling price of the revenue from handset, match it with the cost of handsets, match the revenue for network, match it with the cost of network. So there must be a way that can be done, because you can't insist the customers to pay 275. You've allowed them pay 250,000 already. So the question is, how do we allocate this 250,000 in such a way we can identify the one that goes for handsets and the ones that goes for network? So that is what this is all about. Okay. So of course, we're going to be using math to allocate. So how do we allocate? So let's say you have it as for standalone. So I'm not writing it very well now. All right. Okay, so there's a standalone. All right. So I have handset. It goes for 75,000. Then I have network service. It goes for 200,000. Both of them go for 275. Okay, so this is how I organize it as a standalone. But because I've sold it as a combined product, then I will have to find a ratio or a way to apportion the price. So how do I know? How do I know how to apportion, or what metrics will I be using to apportion? If as a standalone, I would have kind of recognize revenue to the tune of 275. So the question is, what is the portion or proportion of answer to the total revenue? All right. So the proportion of answer to the total revenue will be 75,000 over 275,000. Okay. That's for answers. Now the proportion for network service would be, all right, would be 200,000 divided by 275,000. Can anyone tell me what they will get? Can you punch your calculator and give me your numbers? All right, I'm waiting. I don't want to just drop the numbers. Just give me your numbers. Let me be sure you're following me.
For handsets, it is 0.27.
Okay, so which is 27.27%, isn't it? Yes, thank you. For network service,
Point 727.
Hmm,
72, 72.
is it correct? Okay, I think you're
Yes.
okay. Thank you. All right, so this is the proportion now. So how are we going to now allocate? We're going to allocate based on this proportion. Remember that as a combine, we sold it as a combine for 250. So to know how much goes to handsets, we would say 27.27% times 250,000. I need your numbers. So this one two times 250,000. I'm waiting for your numbers. Drop your numbers.
68,175 naira.
Yeah. Thank you. The other one. Waiting. Key time, 72.73% times 250,000. What's going on? Should we start turning on our videos?
The answer is 181,825 naira.
Okay. So that's how we're going to be apportioning the revenue. All right. So now we've apportioned. The next step is, how do we recognize, or how much do we recognize the revenue? Why do we need that? Because the years in which this, where is it again? It says that, yes, that calculates the revenue from this contract for the accounting year ended 2019 and 2020. All right, so remember that they got into the contract with the customer on the 1st of September 2019. Now look at the date. They got into the contract in September 1st, 2019, and the financial year end of the company is September 30th. And it says that the contract is such that the network service is separately provided for 1 year. So you've gotten your handset, but we're not giving you the entire network service data, in the first year. We're going to be providing it over a 1 year period. So you see the difference now. So the customer will be paid, the sum of 200,000 for 1 year duration. So the customer will be made to pay 200. So that means for the network, is obviously paying 200,000 for 1 year, while for the handset is paying 75. So that means we need to find a way to recognize the revenue for the handset and revenue for the what's it called, network service in those two financial years. So we have recognition of revenue for the year ended. For the year ended 30th of September 2019. All right. So there are 2 years. So because the contract was entered on the first day of September 2019. So the network that can provide it for that year just for 1 month, because the financial year ends 30th of September 2019. So that means the remaining 11 months is outside that financial year. The remaining 11 months will be in 2020. All right. So how do we now apportion? So we know handsets is a one-off, cost, and it has been clearly apportioned and said, oh, we already know handsets cost us 68,175. So the real question is, how do we apportion for network service? So this is how you're going to recognize that. So you're going to have handset again, because now you're not recognizing revenue in the books. So handset is 68,175. Then you have network service. So how do we apportion that? We know the entire amount for network service. However, for the 1 month is okay, let me put it here, is 1/12 times the total amount for network service is 1/8 based on our previous calculation. This is it. So 1/12 times 1/81825. Can I get answers? Can I get answers? What's that? Can I get answers? Can I get answers? Everybody, can I get answers? Monica, can you speak to me?
15,152 naira.
Okay. I hope we all agree with R. 15,152.
Yes.
So that means, thank you. So that means for that financial year, if you add it together, you have 83,327. I believe I'm correct. So you go back again and then write revenue recognition. You don't have to write it again. You can just type, see the written recognition at the point. You can just say 30th September 2020. All right. Okay. In 2020, will answers be recognized? Can I get anybody to respond? Will answers be recognized in 2020?
No, ma.
Thank you very much.
No,
No,
ma.
ma'am. No, thank you very
Which
much.
has
Thank you.
been
Yes, exactly. Exactly. It was a one-off, cost, so it's gone. So what will be recognized in 2020 is the network service. And how many months are we going to be looking at here? Because the 1 year plan, we've done 1 month. Beautiful. Thank you. 11 months times 181,825. Can you see? Very simple. All right. And the examiner said it was badly, but this question was not well attended to in the examination. All right. So if you take that, you have 166673. So you can see how interesting this is. Really simple, right? Okay. So now I'm returning back to my notes so that we can move on. Um, okay. Okay, so that's it. So the next one is yes, recognize revenue when or as an entity performs obligation. Remember our COPA. Can anyone remind me what is C from our COPA? What is C?
Identify the contract with the customer.
Thank you. Contracts with customer. Okay. What is O?
Identify the separate
Identify the
performance of
separate.
Separate performance. All right.
obligations.
Obligation. Thank you. So what is P?
Determine the
Find out
transaction
the
price.
transaction price.
Thank you. Determine the transaction price. Okay. You can write it too so that you just know it. What is A?
Allocate the transaction price to the different performance options.
Thank you. Right, so allocate this transaction price. Why R is what?
Recognize revenue.
Recognize revenue
Thank you.
when the performance of the business is satisfied.
Okay, thank you very much. Please, can we, I don't know, just give yourself a round of applause. Beautiful. Thank you. So, yes. So we've done C, we've done O. All right. So, where are we now? We have recognized revenue. We've done determine the transaction price. So we've allocated with that example. So we're now recognizing revenue. So recognize the revenue of the transaction price allocated to the performance obligation. All right. So an asset is transferred or as the customer obtains control of the asset. Control of an asset refers to the fact that the customer can use the asset and direct the use of the asset to obtain, substantial economic benefit from the asset. Now, the point here is when should it appear in our books? When should we recognize revenue? All right. So as long as the amount of the transaction price has been allocated to the performance that has been performed or performance that the organization has performed or the obligation the organization has performed. So if you've done 10%, it's only 10% you can recognize. All right. Even though you receive, even if you receive cash. So sometimes the customer might pay you. So you receive cash for just like what is going on with us now, right? So you guys have paid for this class, but you'll be getting your service over a 1 month period. All right. So if I'm going to be recording monthly income or monthly revenue, it would be wrong to recognize the entire money that you paid as revenue. I will only recognize the amount you paid as cash received. All right. Or receivables if money wasn't paid immediately. So cash received or receivable, that's what I would recognize, right? And the entire money I'll be put, let's say 10,005. That's what I would recognize, 10,005. However, the revenue cannot be 10,005. I've received 10,005 as cash, but I cannot recognize revenue as 10,005. I'm going to recognize revenue if it's a per day recognition. I'm going to be looking at the portion of today's revenue in the 10,005. All right, so maybe 1/30 then 10,005. That will be what the revenue for today will be. All right, so that's how to smartly recognize revenue. That's what the standard is trying to emphasize. So we're going to go into another concept in the standard. So we've done the 5 steps. So the next, another concept we want to look at is the refund liabilities. All right. We're going to be looking at refund liabilities. What are refund, liabilities? What does it mean? All right. So for instance, an entity might be selling goods to a customer, and there is like an expectation that for every time we sell, we always have situations where 2% of the goods that are being sold will be returned. All right. Now, if a customer is returning the goods back to you for maybe damage or whatnot, or the good doesn't meet, for some reason, the good is being returned, you are owing the customer automatically. So that's why it's a refund liability. It becomes a liability to you. The customer has paid you, but then you haven't the customer has paid for the service or hasn't even paid, or maybe it could be receivables, but the customer is meant to pay because receivable means they have an obligation to pay. So the customer is meant to pay or the customer has paid, and then it comes around, and then return, some of the goods that he has paid for. When a customer return the goods he's paid for, what it means is you have to pay, the customer back, the amount he has paid. You have to kind of do a refund. So what we like to do in accounting is we won't wait for that to happen. All right. So we would do like an estimation or like an estimate of what is likely to be refunded based on past and customary practice. So we already know for this product, 2% of them will be, returned. And when that happens, you want to recognize, a refund liability. That is a liability account that can help you refund money to the customer whenever there's any form of return, that takes place. So that's what this is about. So an entity might expect to return some or of the consideration received from a customer because the customer has probably returned a good or some part of the goods to the entity. So the entity will then have to pay the customer for that. All right. So a very typical example, a lot of us buy certain things. Okay, let me assume, okay, for instance, you buy I think they do that for people that sell eggs, right? You buy eggs, right? And then maybe there's an assurance that the eggs are all good, but you never know until you break an egg. And you get home and you realize that some of the eggs are bad. But by the time you bought the egg, you already paid or you have an obligation to pay. And then you get back and you realize that the eggs are bad. You could go back and then return the bad eggs. What it means that when the moment you return those eggs, the cost and the entity that sold the egg to you, it's therefore owing you automatically. So they have to recognize
Is
that
that like
lab.
what?
What is it?
Okay.
I didn't get you. Who is that? Okay. All right.
Sorry, it
So
was an error.
okay, all right. You can unmute and can mute your mic so that's yeah. A refund liability is measured at the amount of consideration received or receivable, all right, for which the entity does not expect to be entitled to. It must be updated at the end of each reporting period for changes in circumstances. All right. So as the circumstance change, you thought 2% to be returned, but however, 4% was returned, or you estimated 2% return, however, 1% was returned. So you then need to update it, at the end of the reporting period. Okay, so let's take an example to better explain it. So you can take a screenshot of this one before we get into it. Take a screenshot. Sure, don't let me know. Okay, I believe you should be done by now. Okay, so I'm getting back to my notes. Right. Right. So okay, so somebody should read for us. Charles, can Charles read for us? Charles, can you read for us? So are you in class? I call you and you don't respond. That means you're probably not in class. So, Charles, okay, can Maureen read for us? Maureen,
All right, ma'am.
go ahead, please.
Fontel Nigeria Limited is a network service provider registered with the Nigeria Stock Exchange. The company has been operating in the country for the past 10 years.
Wait,
On
where are you?
September Hello?
Where are you? One slide. The last one you took now on this slide 14 on
Mama, can you hear
September
me?
Oh,
20th.
sorry. Yes,
Okay,
yes, yes.
all
Okay.
right.
September 20th, 2019, Fontel Nigeria Limited sold 100 units of Android PT tablets to a major customer for 200,000 naira each. The PT tablets cost Fontel Nigeria Limited 160,000 naira each. The terms of sales are that the customers have the right to return the tablets for a full refund within 3 months. On expiration of the 3 months period, the customer can no longer return the PT tablets and payment becomes immediately due. Fontel has entered into transactions of this type with these customers previously and can reliably estimate that 4% of the Android PT tablets are likely to be returned within the 3 months period. Required: explain how the above transactions should be reported in the financial statements of Fontel Nigeria Limited for the year ended September 30th, 2019.
Very much. Now look at the marks allotted to this question. 4 marks. So you can't afford to waste time on this one. 4 marks. No wasting of time. You cannot be writing an epistle here. You have to just get straight to the point. The one we just solved the other time was 10 marks, but this one just 4 marks. So what are you picking? You have to really be able to pick the right things there. So the requirement is for you to explain. So that's why you can't be rambling. With 4 marks, the explanation has to be clear, concise. How the transaction will be reported in the financial statement of Fontel Nigeria Limited for the year ended. So, but despite the fact that it says explain, you have to probably also perform some computations if need be. All right. So don't always get don't be deceived that if a computational question then have explained, then you just need to explain what you will do. If it involves you putting up some form of computation to further buttress your point, please go ahead and do that. All right. So in this situation, we have it that Fontel sold 100 units of Android, all right, to a customer for 200,000 each. All right, so the cost related to that is the selling price is 200,000 each, but the cost to each of them is just 160,000, right? So automatically you want to recognize revenue, you want to recognize your cost of sale. You can tell this case. But the question is, can you really recognize revenue in terms of can you have your revenue as 200,000 times 100 units? All right. So is it appropriate to have your revenue, that will give us, is it appropriate to have your revenue, recognized? And that's 20 million. All right. Is it appropriate to have it at 20 million? Knowing that there are some terms and conditions that applies. The terms of sales are that customers have a right to return the tablet for a refund within 3 months. So when they write a refund, they have a right for a refund in 3 months. On expiration of the 3-month period, the customer can no longer return the PT tablet and payment becomes immediately due. However, Fontel has entered into a sort of transaction of this type with this customer previously and can reliably estimate that 4% of the Android tablets are likely to be returned. So based on estimates, right, they can identify that 4% of the 100 units of Android that was sold will be or will likely be returned. All right. So what it means is that because it's going to be likely to be returned, we cannot afford to recognize the entire 20 million naira as revenue. All right. We cannot, we fine, we are going to be receiving cash of 20 million, but whenever we then need to pay back, so that means we need to make an allowance because the product might be returned. We need to make an allowance. So your revenue cannot be towards the entire 20 million. That means revenue will be part of it. Then, of course, there has to be a liability to be recognized. And that liability is such that in case the customer returns any of the products, we can then pay the customer, for the product that has been returned. So there must be a refund liability. So you need to recognize the revenue, the refund liability, and the amount that was received or will be received regarding or concerning the assets. I hope that makes sense. All right. So let's now find out. So you have to really be fast. We already know the revenue expected. We expect that 20 million naira should be recognized, but we cannot. So we can only say that we receive cash or receivables. All right. If it's not yet received, it's receivables, which is there's a debit here, there's a credit here. So if you say receivables or cash of 20 million. Okay, so the next question we want to know is, okay, so how much should be recognized as revenue? Okay, so this is debit here. So how much should be recognized as revenue? We cannot recognize this entire 20,000. Nope. We're only going to be recognizing to the tune of what is sure, what we know customers will not be returning. And okay, so if out of 100, if they're going to be returning 4, possibility of returning 4, so that means what the total amount that we will think will not be returned is 96. So we can say 200,000 times, times 96. All right. And that will give us 19,200,000. Okay. And that becomes our revenue. Okay, for the period. So you can see why this standard is important, because a regular accounting person that even went through, accounting level would have recognized revenue at 200,000 and 20,000, but you won't be doing that. Thank God you've learned this standard now, so you won't do that any longer. So you say 19,200,000. Now the account is not obviously balanced. So what will be the corresponding entry? Of course, sorry, that is a mistake. Oh God. Okay, so let me rewrite that so that in case you get the lecture, there won't be any confusion. Okay, now it's not a balance. So that is the contract, refund liability. Okay, so the refund liability will be the difference, which is 800,000. All right, I believe that makes sense. Does it make sense, class?
Yes, it does.
Okay, good. So the question says explain. So what are you going to be explaining? Just explain through what you've done here that when sales are made, the entire amount that were made on sales will be received either as cash or were received, or if not, will be recognized, of course, as receivables, depending on how the question is structured. So will be recognized as receivables, and revenue to be recorded for the period would just be the amount of goods that would not be returned. And then the amount of goods that might be returned will then be recognized as a refund in a liability. All right. So apart from that, we also want to find there has to be like a matching. Since the question wasn't clear on, it said we should explain. Okay, so we have to just cover up anything else that might be required of us from the question. All right. So we might also want to show forth the matching concept. Okay. So how many phones did we eventually sell? If we're going to be looking at cost of sales, of course you will say, oh, we sold 100, but remember that there is a 96 that is sure. There's still a 4 that is not sure. So we'll say, okay, maybe the cost of sales would be 160,000 times 96. All right. So that will give me 15. That's the cost it will cost me to sell one. That's 15,360,000. Okay. Okay. And if that's so, we need to also recognize the return assets. All right. So as the goods will come back, right? We still need to recognize that that goods is coming back, so which will increase our inventory. All right. So inventory was 5 before, but now that they've returned the goods, inventory would increase, and that means there must be evaluation for that. So we're going to be having the question is how much is that part? It's only 4 goods that might be returned, right? So that's 4 times 160. Yeah, that will give us 640. So you say 160,000, right? Times 4. 160,000 times 4. That will give us 640. Yeah. So this will be recognized as cost of sales, and this will be recognized as right of return assets. All right. Okay, so that's it. Nothing, no big deal about that. Does anybody need any form of explanation or any clarification? Anyone? Okay, thank
I
you.
just want to ask,
Go, please.
is this how we need to state it
Is this what?
in the exams? Is this how we are going to state it before the explanation? This
Is this how
workings.
we're going to, the working? Yes, you
Is
have
this
to
how
show
we
the.
working? Yes. This
Wait, I
way, this
can't.
exact way. Okay.
Yes, plus the explanation. No, I made some explanation.
Yes, yes, ma'am. Yes.
Yes, you have to include your explanation, show the workings, how you got the numbers, provide the accounting entries when necessary, and then give your explanation. Yeah. So the marking scheme, I think, let me just show you the marking scheme so that you see how they also presented their answer. Because that marking scheme is our guide. It helps us to know the mind of the examiner and know how, what our expectations are. So this is what the examiner included. So it shows that, so, just narrations and then explanation of the way it was worked and all that. Okay. Okay, I didn't mention profits. Yes, of course, you're going to divide your profits, and your profits would be the revenue that revenue of, like we do from revenue minus cost of sales. All right. So the revenue, of course, is the one that is sure, the one that we know might not be returned, and the cost of sales to that, of course, it has to match. If 96 were recognized as revenue, then 96 we should recognize as cost of sales, and then that will give us a profit of 3,840,000. Okay, so we move to the next thing. Okay, that's the solution. So there's another aspect we might need to look at, which is the aspect of time value of money. So what do we do if we want to take into cognizance time value of money? Because the truth is, if I'm going to be rendering a service for a period of time, and I'm claiming that revenue should, according to the standard, revenue should be recognized the same way, I'm going to render the service over a period of time, revenue should be recognized over a period of time, but time is not static. All right. So the 1 million naira I want to receive in 5 years to come is not the same value of 1 million naira today. So the question is, in real terms, can I really say the amount that I'll be receiving in 5 years' time should be equated to the amount that I would have received if I were to receive that amount today? So there should be some sort of time value of money that should be factored in the determination of revenue. So this question would help us to know, what do we do when such comes up? So it says an enterprise sells a machine on the 1st of January 2025. The terms of sale are that the enterprise will receive 5 million naira on 31st of December 2006. That's 2 years later. And that there's going to be an appropriate discount rate. So the moment you even see discount, you know the examiner may not even tell you time value of money. You see discounts, you see payment period exceeding a period, then that suggests to you the time value of money should be looked at. Okay, now let's think about it. This business or the enterprise sold the machine 1st of January 2005. Okay, so what it means is that there's an entire 1 year, okay, from that time to 31st of December 2005. That's 1 year. All right. Then we have 1st of January 2006 to 31st of December 2006. That's year two. So we can see why they said 2 years later. Okay. So now I'm going to be receiving, remember, look at the way the question was structured. The terms of sale are that the enterprise will receive 5 million naira. So this 5 million naira is coming in year two. All right. So you have year one, year two. This 5 million naira is coming in year two for an obligation that will be performed from year one. So you can see what's going on, right? So, and we said we want to apportion this, in basis on year one and year two. But the question, this 5 million is not the same in year one. This 5 million, if I were to, somebody tells me they're going to pay me 5 million in 2 years' time. The truth is, the value of 5 million today, right, cannot be compared to the value of 5 million in 2 years' time. So if all things being equal, we expect that the 5 million naira today will be lower. The value when you convert that 5 million naira tomorrow and you convert it to the 5 million naira today, the amount will drop. It will drop. It will be a lower amount. So that's what we're going to be looking at. So how do we do that? So we want to determine the revenue. We also want to determine, the effect of the time value. All right. So what is the implication on that? Okay, so let's begin with the revenue. So if somebody's going to pay me 5 million naira in 2 years to come, so the question is, what is the value of 5 million naira today, given a discount rate of 6%? So that's where discount comes in place. So I would then have to discount the 5 million naira, that I'll be getting in 2 years' time. I have to discount it to know what the real value is today in 2025. I remember that if I'm going to be discounting something that was going to happen in 2 years' time, discount it to the present time. If the number of years is 2 years, then I have to make sure that when I'm discounting with 2 years. All right. So let's show how that would happen. So you're going to have consideration, which is 5 million naira, right, times the I don't know if you remember this in your, you know, finance. Okay, so you do this as discounts, to check the present value. Okay, so this is it. So what does that mean? 1/1 plus R means we're told 6%, that's rate, so 0.06 raised to power n. N means 2 years, 2 years. Why is it 2 years? The money is coming up in 2 years' time. So I need to discount what the value of that money is to date to know what it is. So if I discount that, I realize that if I multiply this by 5,000, 5 million naira, I'm going to get 4,449, 982. All right. So can I get anyone to confirm these numbers or disagree with the numbers? Anyone? Okay, I hope it is clear. Is it clear to everybody? I need response, please. Don't ghost me. Is it clear, everybody? Is it clear? Hello?
Yes, sorry, I was trying to confirm the calculation. Yes, it's clear to me.
Okay.
It's clear.
Okay. Thank you very much. Okay, so I need those responses, to help me keep going on. Okay, so now that we've decided that this is this, okay, so let me go to my workbook so I can properly present this, Okay, so we're looking at the effect of time value of money. So in 2020, we're going to split in 2 years. In 2025, all right. So if you're going to be discounting at the beginning of 2025, of course, you're going to have a full 2 years to do that. So in 2025, we're going to consider that the amount will be 5 million times 1 over 1 plus R over raised power 2. Okay, let me put the real figures. R is 0.06 raised to power 2. Okay, so what you have is 4,449,982. Yeah, so what do? We recognize revenue. So what are we recognizing? Revenue and receivables. Why are we recognizing receivables? We said will receive, all right? So obviously it is not yet received, but this is the value as of today. Okay, so you have debits, the receivables, credits, the revenue, the same amount. Okay, so now we've identified the revenue. Of course, we know it's not yet, complete. So because of the discount, there's something we call unwinding, all right? Or let me make it simpler. We would then have to determine the value of the interest. Interest means what changed. So it's like 5 million has now reduced to 404,449,982. Why is that so? Because there was a time value of money degradation that happened. So what is the value of that degradation? Okay, so what's the interest on that? Because we believe that, there's a reduction. So what's the interest, recognition on that? So how do we even find what that degradation is? So we'll say interest recognition, okay, is equals to 4,449. So let's find the difference, the at such that when we get next year, the amount would have dropped. So we said this times 6%. When you're unwinding, that's what you do. 3 times this times 6%. That will give you 266,999. Now you will see where it adds up anyway. So this is saying that in the next year, all right, which is 1 year before the expiration date, if I say receivables, because it's still going to be receivables, and I'm going to have it as revenue. Of course, this time is the interest rate. So we have the receivables is 266,999 and 266,999. Okay, so when we do that, let's now think about the implication of what I just did. You don't have to put in your notes when you're writing the exams, just to have an understanding, because this thing is about understanding. What have we just done? We're saying that when we get from 2025, if you look at it in 2 years' time, so this is beginning of 2025, which is literally end of 2020, so in 2005, which is in accounting is the end of 2004. Okay, so end of 2004 projected into end of 2006 gave us this amount. Okay, so if I'm now in end of 2005, all right, not yet in 2026, just 1 year, after. If I'm end of 2000, how much would that value be? So obviously, you have to then discount, using 1 year rather than 2 years. So if you discount using 1 year rather than 2 years, that amount you get, all right? Okay, let's quickly do that so that you get what I'm saying. So in 2006, all right, we're going to determine that amount. And how do we determine it? Still the same, 5 million times 1 over 1 plus 0.06 raised power 1. Why is it raised power 1? Because we're in 2026. I mean 26. So let's assume we're in 2025. We want to see the value of something that is coming in 2026. It's just a 1 year thing. All right. So that's how we're using this one. So times 1. That would give us, please try and understand these things. I know accountants, we like to work things out. We know how to move numbers, but explanation matters because we really don't know where ICAN is going. It's a new syllabus. We don't know, and we're not scared anyway. We're not scared at all. But we want to be able to prepare ourselves in a way that we understand everything and then we can navigate through, the question. Okay. So the unwinding effect to give me, if I'm going to recognize this in my books, I have debits, receivables, and I have credits revenue. Okay, so for receivables is 4716981. 4761981. Okay, so now the unwinding effect too has to happen. So what will be the unwinding effect? That will be 4716981 times 6%. Okay, that will give us 283,019. Okay, so what do you do with this? Debits, receivables, credits, revenue. Okay, with 283. Yeah, is it clear, class? I need emojis, comments. Is it clear? Emojis. If you don't want to talk, can I get emojis? If you need to raise your hand, please kindly do. Emojis, 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 emojis. That means nobody is in class. Okay, Maureen, thank you. All right, thank you. Thank you. Yes, so we go to the next. So let me get back to my slides now. Okay, so we've shown the effect of time value of money. So now let's look at another concept, right? If performance obligations are satisfied at a point in time, and if they are satisfied over a period of time, is there any difference in the meaning? Yes. All right. So performance obligation satisfied at a point in time means that it is satisfied once and at that point. And so there's a clause that any performance obligation that is not satisfied over time would then be regarded to be a performance obligation that is satisfied at a point in time. So the opposite of this is performance obligation that is satisfied over time. All right. So over a period of time. Okay. So what we have is these performance obligation are not performed in 1 year or something. It involves company transferring control of a good or service over time, therefore satisfying the performance obligation and recognizing the revenue over time. So we've learned how to apportion, how to move revenue to the right place. All right. So let's move on. So what are the things that, or what are the criteria that needs to be taken note of, to satisfy over time? So the first one is want to recognize revenue if one of the following criteria is available. So number one, the customer simultaneously receives and consumes the benefit as the entity performs the obligation. So when you say something is performed over time. So what are we looking at for? Oh, did the customer receive an benefit as the entity performs? Yes, the customer receives benefits as the entity performs. So we know that's an indicator. It could also be the company's performance creates or enhance an asset that the customer control. Okay, so that also point to something. Then the other one says the company performance does not create an asset with an alternative use. Yes. So the entity has an enforceable right to payment for performance completed, to date. So these are the indicators that help us to know if because nobody's going to tell you plain blank that the performance obligation is satisfied over a period of time. No, you're going to be looking out for these metrics. All right. So then you know it's satisfied over a period of time. Okay, so where are we now? Okay, so now let's still on that same discussion. So this satisfaction, one very good example is construction contracts. Okay, construction contracts are such that you have to perform the obligation over a period of time. You get a contract to build certain infrastructure in any place. You probably may not finish in one accounting period. You might have to do it for more accounting period. So if that's the case, so the question is, how do we, clearly identify the revenue, clearly identify the cost, clearly know what profit we're making or not? Okay, so this then gives room for us to measure, okay, what has been completed. Okay, before I even know how much to recognize the revenue or how much to recognize our cost or how much to be recognized as profit. So the question is, what's the output method or what's the input method? Now, what does this mean? How do I rate the services I have offered? Now, let's take what we are doing in class now. How does Dr. Ezewoke, how would you think I would rate the service I've offered? Am I going to be basing it on outputs in terms of the milestones that we have achieved thus far? Or will I be looking at it from the cost I have imputed in this, this service over time or, thus far? So it's a very, very relatable thing, right? So if we're going to go with milestone, we'll say, oh, let's look at our tracker. We have 100% issues to make sure we get to. And the more we attend these classes, we can tick off, and then we can then say, oh, we have just few number of days because every time we taking off the classes in the tracker, and then we can tell that, oh, we've only done 5%, we've only done 10%. So milestone is definitely going to be used for that. So we've achieved 10% out of 100%, so that's milestone. That's an example of us using an output, method. And so it includes surveys of performance that has been completed. So you have to do a survey of what the performance that completed is about. Appraisal of the results achieved. Okay, you can also look at it from what is the result or what the result have I achieved, appraise it. You can also look at it from the milestones that have been reached, and also the time elapsed and the unit sold or the unit, deliver. So these are the things that help us to know that this is purely going to be an output method. And it's important because of these matters in determining the, revenue. All right. So then the next one is the input method, which talks about cost to cost. So the revenue recognize revenue on the basis of the entity's effort or input to the satisfaction of the performance obligation. Now, what does that mean? So, unlike the output method, where we're looking at milestone, what has been done, what have we achieved, how many boxes have we checked? The input method is not. It's saying how much have I expended on this, So let me rate, that based on the amount that has been expended. Okay. So for instance, labor hours expended relative to total expected labor hours. Okay. So I expect that this job should be completed with a minimum 100,000 hours, labor hours, So if it's 100,000 labor hours, so how many hours have been completed thus far? So that's an example of the input method. All right. Cost incurred relative to expected total cost to satisfy the performance. Yes, it may be appropriate to recognize revenue on a straight line basis where they're expended evenly throughout the performance period. So I think with these few points, we now then know the difference between using the output method and using the input method. So remember that the question might not explicitly tell you you're going to be using the output method or the input method. So you have to go through the question then to identify. So if it's going to be an input method, you will know. If it's output, then you're seeing things like the survey of performance completed, you're seeing things like milestones have been achieved, units that have been delivered, then you know this is about completion based on what has been done. But if you see information related to the cost, to be expended, the costs are already expended, you can tell that this is a clear case of an input, method. So then you will know how to do. So let me run me through the steps, in order to make it easier for us to perform any computational question on this. So the first thing or the first step now is for you to determine. I also want you to learn it by step 1, step 2. So it's like you are cramming it or you're, I want you to relate with the steps. So from here I have to do this. So the first thing is, you got a contract to build a particular project, and they tell you they're going to pay you bid for the contract, and they said they're going to pay you 5 million naira. All right. So the question is, am I going to determine, am I making a profit or a loss? Let me determine whether there's a profit on this contract or there is a loss in it. So to determine that, the contract price, that is the amount you bidded for, how much is this contract worth? Okay, the cost that has been incurred up to date. So it's important to know how much cost has been incurred to date. And then we also need to discuss to identify the cost that is yet to be incurred. So this formula is not to make you cram it, and because there's a lot to learn, so cramming is not needed, it's not really necessary, really. So you can understand it. So if I want to know if I made a profit or loss on a project, how do I determine that? I look at the contract price, that I bid for, and the cost relating to the contract. Because it's going to be performed over a period of time, it might be difficult for me to know the cost to the cost to date, because it's going to be I'm going to be expending the cost over a period of time. So that's why that cost is split into two. The cost to date, what has been incurred to date, and what will be incurred, in the future, which is cost to complete. So it's simple. It's still, if you add the two together, it's still the total cost expected. All right. Okay. So, but just so that you know that there must be a split, so that we know, okay, the cost to date and the cost to be completed, then we'll find our profits. And that's simple. Step 2 is to determine the progress of the work that has been done. Now, the question is, why do we need to determine the progress? We need to determine the progress because we want to apportion the revenue, we want to apportion the cost. It's still the same mindset with the examples we've done, before. We want to apportion, that's why we need to know the progress. I want to know how many percent were completed. So like what we are doing in our class, now we have a tracker. So the tracker can be our progress. How far have we gone? If we're on 10%, out of 100, it shows that we've only completed 10%. So the progress of our work done is 10%. And how did we determine the 10%? We looked at what is meant to be done, right? And then we look at what has been done. So in this case, of course, this is the case of this one is the case of, okay, how do we now find the monetary, monetary effect to this, contract? So the monetary thing says, okay, since I'm checking, for instance, I'm going to be using the input method. I remember that the input method is really looking at what cost to cost, like what has been expended on this project. Okay, so I would then, to find the progresses, the question is how much have I spent to date? All right, so cost to date. So if cost to date is 20, so the question is, what is the total cost on this contract? Okay, the total cost on this contract is 100. So you can see that the input system, the input method is using cost. All right. Why the output method is using milestone based on revenue. So you're going to see that in a minute. Now it's important so you don't mix it up. So you don't take cost today, then that's the bad thing about cramming things and just so used to seeing it that you don't even understand why. Some people will just go pick cost today, then put it over total revenue, mix it up. But you need to know why. Input means cost to cost, output means milestone. So if I'm going to know the progress I have achieved is to look at what I've spent to date over the total amount of money I should be spending overall. And that will give me the progress of work done. Now, step 2, when you're using the output method. Now, the output method is saying milestones are achieved. So what amount is the work that has been certified? Oh, you've done 50,000 words, or you've achieved the project up to 50,000 out of everything. All right. So work certified over the total revenue. Total revenue is the contract price or the amount we expect, to receive on this project. All right. So work certified over total revenue will tell us how much work has been achieved. So that's to determine the work certified or to determine the progress that were made. All right. So then the next step, which is step 3, is for us to recognize the contract. All right. That's the construction contracts in the statement of P and L. Now, why is this important? Because we want to recognize our revenue. We also want to recognize our costs, and then we want to match clearly our revenue with our cost. All right. So we don't want to have a situation where the cost is just for a period and revenue is for all of the period. So how do we apportion? So the way to apportion is to find the total revenue for the contract. What is the total revenue contract? Multiply by the progress rate. And the progress rate is dependent on whether we're using the input method or what the output method. Like I said, the input method talks about cost, to cost. Why the output method talks about milestones that are being achieved. All right. So this is very important. So we'll multiply by the progress so that we know the total and we'll allocate the revenue, multiply the cost also by the progress to know the allocated cost. And that's it. Hit it. That's it. That's it. And then we put in the individual amounts in the respective account. So the next thing is to determine what is going to look like. Okay, so I put up a note here. Yes, let me quickly go through this before we talk about what happens in the statement of financial position. Now, what is this note supposed to help us with? To know what to do, when we're dealing with what we recorded. So, for instance, when the expected outcome of the contract is a profit, right? So we can tell that. How do we know it's a how do we come about whether it's a profit? When we know that the revenue or the contract price is obviously more than the amounts that were expended in the contract in terms of the cost of the contract. Sometimes you can tell from the beginning, that, oh, I'm going to make a profit from this, even though it's not yet done. I can tell. Okay. So when the expected outcome of the contract is a profit, what it means is when we can tell we're going to make a profit, we recognize revenue on the basis of the contract progress. And that's what we just did. So we recognize revenue based on progress. So that is revenue is going to be on the progress that has been achieved. We're not going to recognize all the revenue just on the progress that has been achieved. And why is that? So because we could tell, or we can tell that we expect a profit, on the contract. However, when the expected outcome of the contract is a loss, so that means we can tell that what we got as what we bid for is actually the cost is more than the contract price. So you can tell already, this could be maybe money has lost value, whatnot, and then you can't go back to the drawing board to fix the price. When that happens, it means that when the expected outcome of the contract is a loss, then you recognize the entire loss in the books. Entire loss in the books. Then the other options, when the expected outcome of the contract is unknown, right? When the expected outcome of a contract is unknown, that is, I don't know if I'm going to make a profit. I don't know if I'm going to make a loss. So what do I do? It says recognize revenue that is on the cost to date, whatever revenue that has come in, recognize based on the cost that has been incurred to date. And the other one say recognize contract costs as an expense in the period. Recognize the contract cost as an expense in the period. So this will help us to understand how to deal with the items under the P and L. Okay, so let me move. So the next one is to recognize what happens in the statement of financial position. How do we recognize this? Okay, in the statement of financial position, why are we interested? We want to know if for so far where we've taken the contract to, we want to know if there's going to be a liability or an asset. Now let me explain. If, for instance, you're supposed to deliver a project in 2 years, okay, and in the first year, and they said they will pay you 3 million for a project in 2 years, and in the first year they pay you 2 million. The question is, do you recognize 2 million The total contract price is 3 million, all right? But in the first year, the upfront paid you 2 million. Did you recognize the entire 2 million? The real question is, if they've paid me 2 million, then I need to know how much have I expended on the contract? How much profit for the one I have expended, that is for the equivalent of the equivalent value of what I've expended, how much profit am I going to get? All right. Then take that and then check it against what has been paid to me. A contract of 2 years of 3 million, I've already collected 2 million in year one. And that doesn't mean I've done the work up to 50%. It might be that I've not even done up to that. So there must be a way where I can tell whether it's now a contract liability or a contract asset. So when will it become a contract liability? Now, the person that employed you to come do the job had already paid you more than what you have done. It's a liability. So it pays you more than what you've achieved. It's automatically a liability. That means that you are now owing them. You're owing the customer because they've paid, for services higher, than what has been achieved. And this is important so that when you're matching, you know that there's a liability at stake here or there's an asset. So what does it become an asset? When the amount paid is not yet, that is the customer is owing you, the amount paid is not yet above what has been, expended in the contract or what expected to have received in the contract. So that's the moment, that's what this format is talking about. So the cost incurred to date plus the profit today. So if I incur 5 naira and I make 1 naira profit, and let me assume there's no loss, so it's 0. So what it means is that what I should get, if this is my cost, if this is my profit, so and I have 6, so it means that whatever they pay me should be such that will help me know whether. So let me assume they pay me 10 naira um as the amount of invoice or bill to date. Okay, so I've already received 10 naira for something that is worth just 6 naira. So what does that mean? It's a liability. It's a liability straight up. It's a liability. And if the reverse is an asset. So let's take an example. All right. So who's going to read this one? This one is short. Just to who's going to read? Who's going to read? I need the volunteers, please. Favor.
Can
Favor.
you shut up? Okay.
Yeah.
ABC Construction Limited signs a contract on January 1st, 2022 to build a bridge for 10 million over 2 years. The contract specifies ABC receives progress payment based on work completed.
Okay. Next slide.
Estimated total costs are 7 million. In 2022, it incurred 2 million. ABC received 6 million in the 2022 and the remainder in 2023. Revenue is recognized over time using the cost to cost input method. How will the revenue be recognized over the 2 years?
Hey, thank you. Very simple. So you can literally just follow the steps. Step 1, determine the overall profit on the contract. Thank you very much, Favor. So what we can identify is that first, before you begin solving, you want to identify your key variables to be sure you can see everything and you know everything is fine. The first thing is we understand that the contract price is 10 million naira. The next thing is we also understand that this service is being provided on a progress basis. Okay, so if the contract price is 10 million naira over 2 years, and we cannot recognize the entire 10 million in year one because it's going to be performed over 2 years. And then it further tells us that the total cost to be incurred on that contract is 7 million. You can tell whether you're going to make a profit or loss without too much. You can tell. If the contract price is 10 million and it's cost me 7 million. I know my overall profit is 3 million, but unfortunately, I cannot recognize the entire 3 million in that year. for a contract that will be happening in 2 years, I can't recognize the entire, as, so I have to find a way where I can split the different accounting periods. Okay. So overall, okay, let me get back to do you guys want to take a screenshot? Take a screenshot so I can get to the notes. Have you taken it? Okay. So I'm going to get to my note now. So if you want to go by steps, that's fine. But just go by reasoning is also fine. Because the reasoning will automatically lead you to the step. So the first thing is to determine the overall profit or loss on the contracts. Let me even see if this contract is making a profit. All right. Overall profit. So how do you determine that? So we're saying the contract price is 10 million. Okay, to know whether we're making profit is to remove the cost, isn't it? So, but we like to split the cost in what has been expended to date. Cost, less cost to date. In the question, can anybody tell me the cost to date? Anyone? The cost to date. Olubumi, cost to date. Olubumi is gone. Okay. Sekinat. Sekinat, the cost to date. Favor.
Trying to go through the question. I have to go
Okay.
through the question.
Okay. I'm waiting. See the cost to date. Are you still with me? Why is not returning the answer? Charles, what's the cost to date? Veronica, Maureen, Sakinat, what's the cost to date? If nobody's answering me. All right. Okay, Favor, yes, go ahead. Just
I
say
can't
it.
find where I put it. The screenshot, I couldn't
Oh, you couldn't
find
find it. Okay, okay,
um,
okay. So we have it that the estimated total cost is 7 million. You can just write it down. In 2022, it incurred 2 million. Okay. ABC received 6 million in 2022, and then the remaining will be received in 2023. it uses the cost to cost impute method. Okay, so to determine the overall profit, cost to date is 2 million. That's how much it had incurred up to date. And then cost to complete is how much it would need to incur to complete, the project. And if the total cost is 7 million and we've already incurred 2 million, then we can infer that the cost to complete, all things being equal, would be 5 million. Okay. Okay, so what we'll have then is we're going to have overall profit and in this case is 3 million. Okay, so we're done with that step. So the next step is to determine the progress. Why do we need the progress? We want to use the progress percentage to determine the revenue and the costs to be allotted, or allocated. All right. So how do we know the progress? In 2022, it's we're using the cost to cost method. It had expended 2 million naira over 7 million. Okay, so that's 28.6%. In 2023, it had expended 5 million over 7 million. How? It's expended 2 million the first year. Second year, it will expend the remaining. So that's the cost to date over total cost. That's 28. Sorry, this one will be 71.4%. Okay. Having that done, the next thing is to recognize the contract in our P&L account. So we need to find the revenue. So how do we allocate the revenue? So far, so good. The progress rate is 28.6% for 2022 and 2023 is 71.4%. All right. So that would be the total revenue, which is the total contract price, is 10 million. So in 2022, all right, so we have 10 million. So this revenue now times 28.6%. So that will give me 286. All right. So in 2024, in 2023, I think is it 1 year again? Let me see the number. Okay, 2023, yes. In 2023, sorry. So in 2023, what do we have? We have 10 million times 71.4%, which is the percentage of completion. That will give me 7140. Now, to determine that revenue, so you put it in your P&L account, revenue is clear. So the next thing is to allocate the cost to match the revenue. So to allocate the cost, so we do the same thing. The 2022, the total cost is 7 million for the project, but the progress for 2022 is 28 based on our progress percentage, and that gives me Then in 2023, we have 7 million times 71.4%, which is 4998. Okay, so that way we've been able to recognize the contract in the P&L account. So we recognize the revenue, we also recognize the cost. So the next thing is to determine what happens in the statement of financial position. We want to recognize if there is a liability a contract liability or a contract asset. Why? If amounts paid has exceeded what service has been rendered, then we know it's a liability. But if amount paid has not, then it's an asset. So let's determine that. So the way we determine that is to find the cost that has been incurred, okay, and the profits that is related to the cost that has been incurred, okay. So let me call it okay. So what do we have here? So you have what has been incurred to date. You've in for 2022 now, we've incurred 2 million. Okay. So what's the profit on that 2 million? Expect that if the total profit is 3 million and the progress for the first year is 28.6, that is the equivalent of the profit made for that period. So we have 858. Okay. The next thing is there any loss? No loss. So what has been billed or what has been paid or what has been received? So we've received receivables. We've received 6 million. So that means we've received more. If you look at it, it's actually more than what that is associated with what we've done. We've only incurred, and this is the profit. So it's like your markup and your cost together, and then you've received more than that. So that's like a contract liability. So if the difference will give me 3142, all right. So that's contract liability. So the next thing is in 2023. All right. So 2023 will say cost to date. To date means all the costs from the beginning to now. So far, so good. We've incurred 7 million because that's the total cost. Then we recognize the profit to date. That is the entire profit. We expect 3 million. Okay. So the question is, how much has been billed to date? Amount received to date. So we've received to date, we've received 10 million. So that means it's balanced. What we've received is equivalent to what we've done so far. So there is no liability, there is no assets. It's just nil. So no contract liability, no contract asset. So that's it. Really no big deal. So let's quickly take we're done with the topic. We just want to take some past questions. So are we ready for that? I want to get responses if you're ready. Please, can you comment? Can you let me know if you're ready? Tell me you're ready if you're so that everybody can participate in testing and knowledge we've learned. Let's see if you can remember. Okay? Are we ready? Are we ready? Today is I don't know, the class is cold today. What's going on? Nobody's responding to me. What's going on? Have we all slept? Favor.
We are
No, ma, we are
we are not
still
sleeping,
here.
but tired.
Oh, sorry. Just try. Don't worry. The journey is almost, you are closer than you think. Closer to the end. Just keep trying, huh? Okay, so that's why you need to talk so that it will help you, to help you stay concentrated. So try and, reply the questions. I think that will keep you going. All right. All right. Okay, so we have a question here. So Favor, can you read the question?
November 2019, question 6. Explain how IFRS 15 is expected to improve the financial reporting of revenue. 6
Yes.
marks.
Yeah. So let's start with you, Favor. Drop 1 point. With what you've learned, no, that's why you need to understand it, right? So it's not like there's a part we've done that we said, oh, these are the how revenue will improve financial reporting. But because we've understood it, we can come up with expected ways in which revenue can improve improve the financial reporting. How this standard IFRS 15. So Favor, give us a point. How do you think this standard can improve revenue recognition?
Let me just use my brain, not as it is written. I think with IFRS 15, you have an idea of recording what is exactly what you should record as revenue, not what you think that you have sold. In case of where you have goods to be returned or things
Okay.
like that, you will not register the revenue fully, but you make provision for other things that has happened in between, like goods that are returned and all that.
Okay. So can you give us short phrases, one or two? How, so we're thinking we're an example, we want to write this. How am I going to write it? You've explained brilliance. Can you give us like a short phrase or how you would have written it in the books? All right. How has IFRS 15 improved revenue recognition? So you want to start with, IFRS 15 has improved or will improve or is expected to improve revenue recognition because it allows for revenue to be recognized. For instance, it allows revenue to be recognized when obligations are being performed. Something like that over a period of time. So it's bringing that. It also brings IFRS 15 brings a 5-step model that helps to determine when revenue should be recognized. And then just mentions of those steps and thereby reducing um reducing um overestimation of revenue in the books. So, just freestyle from what you've learned.
Okay.
Yes.
Yes, ma'am.
Yes, freestyle from what you've learned because the truth is the examiner wants to see that you've written it, you know it, but they want to see that you've used the right, wordings. All right. So can anybody give it a try? Can anybody give it a try? Just one line. Tell us how IFRS 15 is expected to improve revenue recognition.
Okay, let me try my.
Go ahead, please.
Okay, so IFRS 15 is expected to improve financial reporting of revenue by helping us identify the various performance obligations.
Good. Good.
Okay,
Yeah.
all
Mm-hmm.
right, and then it makes us able to identify the profit.
Mm.
It
Make us.
helps us to be able to identify
No,
it.
not help us. It's not helping us. You are writing and not
Okay,
speaking. Yes.
okay,
It
okay,
helps to
okay. Let
improve.
me.
It provides a
Okay, it's
better. Uh-huh.
all right. It helps to improve the recognition of profits and costs incurred to the various dates of completion.
Beautiful. Cool. Yes. So just freestyle what you already know and indicates it. And because we are saying improving revenue recognition, you need to touch on something under the conceptual framework. In a sense, the IFRS 15 provides a relevant, or reliable financial, information. IFRS 15 produces financial information that that faithfully represents the events and transactions that are taking place in the organization. You can say. So you want to see this answer is really you're gonna see the marketing scheme, but my dear, this answer is really extensive. Just really just mentioning those specific indicators under IFRS 15. All right, and explaining how those indicators can actually improve revenue recognition. And the reason for this question was because prior to IFRS 15, there had been a standard. All right. So, and what this is saying there had been a standard on IS 11, there's been one on IS 18. So this IFRS 16 came in and then gave us like an holistic standard. So it's like an argument about the previous standard, but nobody's going to expect it because now this question was in 2019. So your diet right now or your syllabus where you are now, you are far past the old revenue standard. So it's not like you need to make reference. So don't waste the time going to learn the old one. Nobody cares about that any longer. So what you're just doing is telling us in case it comes up in another dimension, you're just telling us how IFRS 15 brings a better, provides more relevant, reliable, comparable, just bringing those things, financial statement, and you will get what you're looking for. So this is the answer based on the pack. All right. Information needs to be verifiable in order to ensure it meets its fundamental criteria. Not just talking about everything. So let's move to the next thing. All right. So it says IFRS 15, revenue from contract with customer defines contract as an agreement between two or more parties that creates an enforceable right and obligation. This also a way to understand that you might be asked to talk about the meaning, all right, of IFRS 16. They may not tell you find what's the meaning. They might say, what does it entail? All right, you should be able to define it, that it concerns a contract, between parties that creates obligations or enforceable rights. Okay, so the question is compare with an example where necessary, a contract liability versus a contract asset. So now they want you to explain or tell us what's the difference between a contract liability and a contract asset. And the only way you can explain this is by understanding. Okay, can anybody speak to us? And this time you're not going to explain to me, you're going to tell me how you write it. All right, so just calm down a bit, look through it, and then put yourself together. If you're going to be writing this on paper, how are you going to write it? So who's ready? Who's ready to go? Who's ready to go? Who's ready to go? Who's ready to go? Who's ready? Sakinat. Sakinat. Veronica. Anybody, please? Test your knowledge. Test the knowledge. There's nothing to be shy. You're not writing for ICAN now. This is time for us to, let me know how you're thinking, tell you how to say it better. Maureen, go ahead, please.
All right. So a contract liability is a situation whereby a company has already been paid for a contract and is expected to perform an obligation to meet up with the contract, while a contract asset is an expected payment for work or obligation that has already been made. I don't know if that makes sense. I'm trying. Like
Yes, you try.
liability is a situation.
Mhm.
Okay, liability is where you have received the payment, but you've not, like, you're under an obligation now to do the work, to perform the contract, while assets is where you've performed the work, but they've not paid you, they've not billed you for that
Mhm.
contract that you
Yeah.
made. I don't know if that makes sense.
Yes, is a contract asset is when it's actually it becomes receivable by the entity, where the entity then expects to receive certain amount from the customer, while a liability is when the entity then is the one that has an obligation to transfer you know goods or service to the customer. So yes, very clear and clear. So what are you bringing on board? You want to use the right wordings. What are the things? The moment they ask you what anything liability, remember that obligation has to come in that definition. So just remember that's why your conceptual framework is important. It sets the tone. So you already know based on your conceptual framework, a liability is the present obligation that involves the transfer of economic resources as a result of past event. You don't necessarily have to quote the exact definition, but you can write around it to be able to provide the answer. So you already know liability. The contract, of course, is an agreement between individuals, two individuals, for one person to perform or for both of them to perform an obligation, and which has enforceable rights and by law and all that. So how do you now combine all of that? Is where the issue is ability to touch on contract, touch on liability. All right. In the same way, we also have a contract asset. For saying this becomes receivable because an entity has probably performed an obligation that requires the customer to pay the entity. So it's just freestyle and use the right words. What right words am I expecting? It's an asset. All right. So it's an asset. So use the words that relates to that economic resource, you know, and as a result of past events, you want to use such things. Okay, so the next one says that compare between a standalone selling price versus a transaction price. What's the difference? Standalone transaction. Oh, please try. Somebody should try. See, saying these things will help you because you are not thinking. In the process of answering this question, you are thinking, and that's where learning is. That's where the learning really gets serious. You're not just listening. Learning is not just by listening. Listening, thinking, ruminating, you know, saying something about what you've learned. It's also a way of reminding yourself that you've learned it well or not. It's also a way of correcting yourself in case you haven't. So let someone speak to the we are few. So we should be able to maximize, our time together. We're not under pressure. We have enough time to, look at all these standards and come out on top. So maximize it. Use me. Disturb me. Just make sure that you're telling yourself, this class must make sense for me. It must make sense. I must get the best out of it. All my questions must be answered. Okay, so can somebody respond to this? Responding. I haven't heard Charles' voice since. Charles, I haven't heard your voice. Maureen,
Yes, ma'am.
please go ahead, Maureen.
Okay. So if I would say for standalone selling price, it has to be like the price of a single good or service, like just one service or good. While transaction price should be like the price they will do it for a whole, like in a group, a whole. That's my attempt.
Okay, thank you. Thank you, Maureen. It's not combined, so don't let them fool you. They intentionally added put standalone price versus transaction price. You think they are like versus vis-a-vis the way they did with contract liabilities versus contract assets. So it looks like, oh, what's an opposite? And then they bring standalone price versus transaction price, making it look like they're one and opposite. Don't let them fool you. So it's standalone price versus combined. All right. So if it's combined, or you want to use distinct goods versus bundle, that kind of thing. So Don't let them fool you. So they are not, even though it's versus doesn't mean they're actually opposite. So standalone, yes, you got it right. In which an entity will sell certain goods or service separately. One thing with standalone is you have to indicate that these things are sold separately. Meaning, I'm buying a telephone set is separate from I'm buying data on my phone. So it's standalone separately. And this is always determined, at the beginning of the contract. Then the transaction price talks about the amount of consideration the entity expects to receive, having provided a service or having delivered, on its contract terms. So what's the expectation the entity expects to receive? So when you're talking about transaction price, consideration is the key word there. So these are accounting keywords that must come in respect of any other words you're going to be using, just to give you that edge and convince the examiner that you know what you're doing. All right? So let's move on. The answer is there. You can always take your time to go through that. So the next one says that under IFRS 15, highlight 6 criteria to assess a contract. What are the criteria to be used to assess a contract? Can anyone remind us? Please, I need response. There's no wrong answer here. Well, anything we say is to learn, to do better. I need response, class. Please go ahead.
I think one of those is to identify the contract. Is that part of it?
Okay. I'm listening.
Determine the transaction price, allocate the transaction price, various performance obligation, recognize revenue when obligation is happening. Am I
Okay.
in the right point?
Yeah. What you did was to give us a 5-step model. All right. Which is fine, fine, because there's some substance that can still be brought in. But what this question is really asking for is to identify the criteria to assess a contract. Remember that when we talked about the 5-step model, the first step was to identify the contract with a customer, and the second was to identify the separate or performance obligation. So let's go back to the first. So when we tell to identify the contract with the customer, we also mentioned what are the application criteria, what are the criteria that identifies the contract with the customer, what are the things that must be present for us to be able to say there is a contract with a customer. So that's what they're asking for. So I like 6 criteria to assess a contract. So that is what criteria will be needed to be used to assess if there is a contract with a customer. I don't know if you get what I'm saying. So the answer is the other one, the APPCC, where we talked about parties have approved the contract, entity can identify parties' rights, they can identify the payment terms. The contract, of course, has a substantial performance, and it is probable the entity will collect the consideration. All right. So I believe that makes sense, right? So that's what they really want us to talk about in terms of the APPCC. All right. Make sense? Right. Okay, so we'll move on to the next. It says, explain what is meant by contract modification and state 2 ways in which it can be accounted for. What does it mean? Contract modification. You modify a contract. What does it mean? I'm waiting. Just tell us. When you modify a contract, what does it mean?
Let me try.
Please go ahead.
To modify a contract. Okay, to modify a contract means to change the terms of the contract, either the obligation or the transaction prices.
Beautiful.
Transaction price.
Beautiful. Changing the scope of the contract. It has been agreed or approved upon by the parties to the contract, isn't it? Remember that we said the first thing in criteria is to identify that it has been approved. It has been approved, but then you're now going back to change the scope of an approved contract. All right. Okay. So modification, changing terms and conditions of the contract, parties changing the contract, and of course are aware of the enforceable rights and obligations. So the next one says, where is it now? Two ways in which it can be accounted for. When there's a contract modification, how can it be accounted for? Right? How can it be accounted for? All right, nobody's saying anything. So how do you account for modification? So by drafting a separate contract apart from the existing one, something else, just so that it's clear that there's been a modification. By terminating the existing one, the contract that used to be, then you terminate it. All right. So let me see, are there other ones? Okay, the answer is there. So we have this one now. I think this should be the last. Yes. This one is coming again. Explain the core principles on which IFRS 15 is based. And then we have explained the 5-step model involved. Okay. Can anyone respond to that? Anyone?
Let me try for the two core principles. The core principles upon which IFRS 15 is based upon.
Okay.
Okay. It has to do with recognizing revenue,
Okay.
and the revenue is recognized in a manner that depicts transfer of goods and services to a customer, and then it should be recognized at an amount that reflects the what the entity has brought out. Sorry, I'm trying to look for the word to use there. What the
Okay.
entity has suggested, like the amounts the
Okay.
entity has suggested for consideration.
The
Yes, those are
transaction
like the
price.
two.
The
Yes, the
transaction price.
transaction price.
Just try. I know you know those
Yes.
words. Just use them. Put them in. Use them. Be aware that those um those words are to be used. Do you understand what I mean? So when you throw it in there to back up whatever it is you want to write, it makes a whole lot of difference. So please use them. Use them. Yes. Okay. Can you respond to the 5-step model? I believe everybody should know that, but can you respond to that?
Okay, the 5-step model. The first is to identify the contract. The second is to identify the separate performance obligation. The third is to determine the transaction price. Fourth is to allocate the transaction price to the separate performance obligations. And then the fifth is to recognize revenue when the contract has been satisfied. When the
Beautiful.
performance
Beautiful.
obligation has been satisfied.
Beautiful. 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 Yes, thank you. I'm impressed. Thank you. So on the first one, the core principles on how IFRS is based, 15 is, remember that we mentioned the issue of we allows for, because I feel like saying what they're doing differently that is enhancing financial reporting. Remember, we mentioned the fact that it allows for proper matching, right? Because now revenue will now be matched to the period in which obligations are being performed. So it allows for a proper matching concept, and also helps to match the revenue are matched with the exact the cost that has been incurred to the period in which the revenue has been realized. It also talks about the fact that it allows for it kind of also open up the Accra concept, by making sure that the revenue basically do not have to be recognized when money is being received. It's recognized when the obligation or when the obligation has been performed. That's also a way to talk about the basis in which the IFRS 15 is actually hinging on, right? Okay, so you have an assignment. Please ensure tomorrow is Saturday. All through the day you have enough time, but only coming in the evening to take our class. So I want to believe that we're going to maximize tomorrow. Remember that on Sunday we're going to be having a mock for 3 hours. All right, our mock is going to be for 3 hours. Or let me put it for 2 hours, 15 minutes. Okay, let's see what happens. Let's see what happens. Anyways, we're going to have a mock on Sunday. What it means is for you to excel in that mock, today and tomorrow are your best times to actually go through everything we've done, all the topics we've done, seek for past questions. I've indicated the past questions, go through the past questions, solve them, and let's see how you're going to fare in the mock that's going to be happening on Sunday. All right. In the absence of any question, can we call it a day? Good night, everybody.
Good night, Ma.
Good night. Have a
Good
blessed
night,
night's
ma. Thank
rest.
you.
You're
Thank
welcome.
you.
You're welcome. You're welcome. Bye.
Bye.
Bye.